We are on live. So I don't know why I'm not able to get this to work on my other page. So I'm gonna try to share this real quick. So those that want to join from my other page can. So let's do this. Let's look for you, Doc. Oh, really? What did we do? Okay, we're right here. Bam. Okay, shit. Awesome. Hey everyone, how are we doing? I hope everyone is off to a great week, right? Or can I say your week is off to a great start? This particular life is so near and dear to my heart because I feel like the tax code was set up for real estate investors and business owners. Okay, I don't know how my volume is doing, but let's see. Oh, by the way, I got a mic. Very special social media leader, everything PR, everything, getting us out there, advised me to get this mic. So I hope it's gonna help. He said it's gonna help with my audio. So let's see how that goes. What did I do? Okay, you guys. Technology is not my forte. Let's go. All right. He said this would be a lot better in terms of voice quality. So it's good to be here, and I'm really excited to talk about real estate investing. So in my opinion, like I said earlier, I think the tax code was set up for two groups of people: business owners and real estate investors. Now, of course, just like with everything, if you do not have a savvy tax person on your side, or if you don't have someone who can educate you on how to leverage all these things, you're going to be missing out on them. Okay, but today's topic, I think, is one of those things I like to drive into people's minds. For those that already own properties, those that are already into real estate investing, great, there's so much for you in here. For those that have not yet thought about it, I just want to encourage them to, because real estate is the next big thing. There's no other way to leave wealth for future generations than in real property, right? In actual real property. And that's where this whole real estate idea comes in. So let's talk about it. Who is a real estate investor to begin with, right? A real estate investor, in the simplest terms, is just someone who puts money into properties for a profit. Okay, that's the simplest term. So I know a lot of people, when you say you talk of real estate investors, they're like, no, I'm not a real estate investor. I'm like, but you own a house that you're renting out, right? Or you're doing Airbnb and all of that. So, or you're buying a property to put on Airbnb. It sometimes is more of a conceptual thing, but there is so much that is in this particular space that I hope that we can really go through today. It's a lot to cover in 10 to 15 minutes, but I hope I leave you guys with a lot. Okay. So a lot of people were fighting Trump because he only paid $750 in taxes, right? And I hate to disappoint you guys, but it's thanks to him being in real estate and a particular classification in the real estate space. So I want to talk to those that are thinking about becoming real estate investors, or those that are already real estate investors, to understand how to classify yourself so that you can maximize the tax deductions that are out there for you guys. Okay, so before we talk about it, how does the IRS look at a real estate investor, right? Because if you decide and you say, I want to buy property to rent out, I want to be able to invest money in this property to pass to future generations, I want it to bring me money, it's so important to understand how the IRS classifies you and how that allows you to really leverage the tax code. Okay, so when you talk about a real estate investor, there are different categories of real estate investors and how the IRS classifies them. Now, you have a passive investor, which is the average person. It's just everyone literally who thinks about buying a property starts from the passive investor phase, where you buy a house, or maybe you had a house and then you move to another state and you need to rent it out, and you have somebody living there, you have a management company that is running it for you, managing it for you. In that case, you're what we call a passive investor. Okay, a passive investor is not doing much as far as you're not maintaining the property or anything, but you own your property and you can still take off certain losses on your property. That's what we call a passive investor. At least that's the bare minimum for everybody. The second group is what we call an active investor. An active investor is someone who is making decisions on, management decision, or who to rent, right? Tenants and things like that. So you're kind of involved in the running of things. And then the last category is what we call a real estate professional, okay? And I'm going to start breaking down what these different categories represent. So a real estate professional is someone that is heavily invested. They are putting in at least 750 hours into the management of their real estate property, or at least 500 hours. And a lot of times they are the ones that are doing the most work. So even if they didn't put in up to 750 hours, but they are the ones that do the most work for their property, it classifies them as a real estate professional. Why does it matter how the IRS classifies you when it comes to real estate, being a real estate investor? Why does it matter if they call you a passive investor, if they call you an active investor, or if they call you a real estate professional? Well, it matters because that's what determines how much you can write off in your business losses, okay? So now, for most of the people that go into real estate has so many benefits, right? You get a property, your property can continue to appreciate. And you can get cash in terms of, a high cash flow because you're renting it out. But then you can write off things like depreciation. Even though your property is appreciating, you're allowed to write off depreciation because depreciation is loss of value that happens when a property is in use or an asset is in use. So there are several expenses that if you incur in running of your real estate, you're able to write those off, okay? And now, depending on how the IRS recognizes you as far as being an investor, it would impact how much you can write off, okay? So now, before we talk about how much you can write off, I need you to understand something that is very crucial to this conversation, and it's the different types of income that anyone who makes money in the US will have to make or generate at a certain point in time, okay? For those who have a job or those that run a business, there's something called active income. So active income is money that comes from your job, is money that you get paid. If you had a business, that operational income you're making, that's what we call active income, okay? That's the first thing. The second thing is what we call portfolio income. This is for people that invest in like the stock exchange, all of that. They have stocks. This is all called portfolio income, right? You always hear that term, people have a big portfolio or that portfolio, that's portfolio income. And then what is called passive income. Okay, passive income now is money that you make from owning real estate properties. For example, the money that you're making in it, that is passive income. So hear me out. You have active income from like a job or business, portfolio income from your investments, and then you have passive income that can come from real estate investments. Now, why are these categories very important? They're important because you remember I said there are three ways that the IRS classifies a real estate investor. You're a passive investor, you're an active investor, or you're a real estate professional. How the IRS classifies you determines how your losses can be written off. Does that make sense? Because everybody has three categories of income. You might not earn all, but if you have a job, you have active income. If you own real estate and you're only a passive investor, the income that you make from your real estate is called passive income. But your passive, and then if you have a loss, it's called passive loss. But your passive loss cannot go against your active income from your job. So being a passive real estate investor, when you have a loss, it's considered a passive loss. Your passive loss can only go against passive income that you earn from another real estate investment. So if you have a loss, which is passive loss because you're a passive investor, which means you're not involved in running, you own a property, somebody else is, managing that for you, you're a passive investor. If you have any losses, because at the end of the day, we want to be able to write those losses so that they can reduce our tax liability, right? So now with you being a passive investor, you having passive losses, if you do not have any passive income, you're just going to have to carry those losses forward because it cannot go against your active income from a job. Okay, now the second group now of real estate investors is what we call your active investors. So active investors, as I explained, are people that are kind of involved in managerial decisions, getting to decide what tenant is going to be able to rent and those kind of things, going through applications and that kind of thing. So when you are actively involved in running your real estate, now when you have losses, still what we call passive losses, a portion of that can go against your active income. which means if you have a job and you're making under 100,000 and your real estate property is bringing you you have a loss incurred of about 25,000, you can write off all of that 25,000 against your active income from your job, which means it gets to reduce the tax liability that you could have had to pay to the IRS. Does that make sense? So which means if you are an active investor, which means you're involved in running your property, you can write off up to 25,000 of your passive losses against your active income. Unlike the passive investor who has passive losses and can only write it against passive income, it cannot go against income from their job or business. An active investor, if they have losses, they can write off some of those losses against their active income. Now, there are a couple of caveats. First, you have to be making less than 100,000. If you make over 100,000, you can write off 50 cents for every dollar, up to 150,000. After that, you're phased out. Second of all, if you have a spouse, both of you cannot make over 200,000 to write off the entire amount. But if you made up to 150 a person or 300, both of you, again the amount phases out. It starts to reduce. So for every dollar, instead of writing off the full 25 against 25, you'll be writing 50 cents against a dollar. So if you earn 125,000, for example, you're only going to be able to write off 12,500. Okay. So as your income is high, as your income increases from your job, you're only able to write off a little bit of the passive losses. And sometimes that's really sad for a lot of investors because they're in high income brackets, and so because of that they're not able to write off those losses. Again, that should not discourage you, because you can carry those losses forward until the day you have passive income or the day you sell the property, and it will reduce your gains. Okay, the last category now is what we call the real estate professional. And the real estate professional is the person that, like I said, qualifies for in a couple of ways. They are materially participating in running the real estate. They put in over 750 hours or even 500, but they are the main person when it comes to doing everything for the real estate. Now, these people are able to write off all of their real estate losses against all forms of income, against their active income, which means there's no limitation of they cannot make over 150,000, for example. No, it doesn't matter how much they make, and it doesn't matter how much they brought in losses. They can write off everything. So if they are able to leverage the tax code and all these different bonus depreciation laws, they are able to write off all of those losses against active income. Can you imagine? Which means if you are, let's say you're married with your spouse and your spouse qualifies as a real estate professional, and you guys brought in even $400,000 and you had passive loss of maybe $200,000, you can write off $200,000 because one of you guys qualifies as a real estate professional. And what is so great about qualifying for a real estate professional is that you're not limited to one property. If you have multiple properties, the IRS allows you to do something called grouping, where you can combine the hours that you spend in your different properties and then you treat them as one. Okay, so now I've kind of given you guys some background. Remember, keep in mind there are three types of income. There is active income from your job or your business, there's portfolio income from your investments, there's passive income that comes from real estate properties. Now, as a real estate investor, you're going to be classified in one of these three categories based on your participation. Okay, one, you're either going to be a passive investor, where it's someone you're not involved in running your property at all, you have some manager managing it for you, or you can be an active investor where you're making those managerial decisions, or you can be a real estate professional. Mind you, I didn't say real estate agent. Real estate professional is completely different. Okay, this is all focused on real estate investing and managing of real estate portfolios and things like that. Okay, so now let's talk about the strategies. Now that you have an understanding of the types of income and how you can be classified and how you're able to leverage your passive losses against your income types, I did put a couple of tips here for you guys. I always try to put something down. Okay, my first thing for you, if you are a real estate investor, from the get-go, the moment you decide and say, I'm going to put properties in the market, or I'm going to purchase properties that I'm going to be renting out, please start to track your records. Look, when I say your records, I'm not just limiting it to bookkeeping. Bookkeeping is crucial, but I want you to also start tracking how many hours you're investing in that real estate property. It's very important because that is what is going to determine how much of your losses you can write off against your active income. So make sure you're documenting everything. You're documenting the time you're spending in managing your properties or in being involved, and then you're also documenting everything you're spending as far as, having a solid bookkeeping system, okay? Because you want to make sure that you're tracking in all of those expenses, all those properties, the cost and all of that, so you can accurately track your depreciation. So record keeping is huge in this space, okay? Second thing I have for you guys is I want you to make sure that you're taking advantage of applicable depreciation. If you've not yet filed your taxes, you still have a shot. If you've filed your taxes, here's the beauty: you can go back and amend. You have 3 years. Or if it doesn't apply to you, you can put this going forward. There are different types of depreciation. We have bonus depreciation. We have different types of depreciation that you can try to figure out what works for you. But one of the best ways to leverage some of this depreciation is using something that you call cost segregation. And cost segregation, what it does is it allows you to be able to divide your properties based on the type of property so that you can expend some of them a lot quicker, okay? So let's say you own a building and you have like fixtures and furniture. That's a property type, right? Now, the way it gets depreciated is different from if you were waiting to depreciate the entire building, which would have taken you like 27 and a half years. But if you went ahead and did that cost segregation, you're going to pull out the fixtures and you say, wait, this stuff is only going to last me 5 years. We're going to depreciate for 5 years. That is you accelerating that depreciation, okay? By you doing that, you're able to increase the amount of depreciation or deductions you can take. That increases your passive losses, and that allows you to be able to limit your tax liability once you bring that against your income, okay? I hope that helps. Third thing I want you to do is, if you are actively working and you have a spouse that is not making a significant amount of money, one of you guys can invest time in managing your properties. So that way you or your spouse can qualify as an active investor or a real estate professional. You want to take advantage of this, okay? Because you're allowed, if one spouse qualifies, you're good. And this is sometimes a lot of information. We cannot go through all of it, but think of it from that material participation. So instead of having to hire people to do a lot of the stuff for you, going through tenant application, marketing, this, you guys can decide to commit the times to doing it. Now, there's another caveat here. You cannot be making a ton of money where you work full time and tell the IRS that you were putting in 40 hours on real estate management. That's not true. That's not gonna fly with the IRS, okay? That's why I'm saying, if you have a spouse who works part time, you can leverage your spouse, okay? Then my fourth tip for you is make sure that you're taking your losses. Even though I explained that sometimes you may not be able to write your passive losses against active income because of how you're classified, you still want to document those losses. Sometimes people go to tax preparers and they don't document those losses. And what happens is, down the road when you decide to sell the property, all those losses that you have incurred, it could help you to reduce any gains that you made. But if you do not have any documentation on those losses, how, you have no proof that you had all those expenses or those losses that you recorded and you never leveraged. So make sure that you are still recording those on your taxes. Let it be reported. All those depreciations, even if it doesn't apply in that time being, still take advantage of it. And then the last one is, if you have multiple properties, you can consider grouping them so you can get more hours to qualify as a real estate professional. And that's where you really get to enjoy. I'm talking about enjoy everything that real estate investing brings to someone who has active income and really wants to reduce their taxable liability, okay? Those are my 5 tips for you guys. So prioritize record keeping from the accounting side to even the hours being invested. Take advantage of applicable depreciation. If you can leverage cost segregation, do that. Make sure that if you can qualify as an active investor or a real estate professional, you or your spouse, you do that. Take your losses, make sure that they are recorded, this year and future years. And lastly, consider grouping your properties so you can get more hours to be treated as a real estate professional. Now, this is a lot of information. However, I also do have a course where I've broken this down. If you want to check out the course, feel free to do that. If you're a real estate investor and you do not have a solid CPA or someone who understands this space and you would like to have a conversation conversation with me, feel free to hop on our calendar or call our office and book some time. This is a lot of information, and I know it can be overwhelming sometimes, but I encourage, anyone who is out there thinking about owning properties, is one of the best ways to not only build wealth, but to build a legacy for your next generation. You want to be wiser about how you go about it. You want to make sure that you have the right information so that you really get to leverage this tax code for you and for your family and all of that, okay? It's also important for you to, one last tip I didn't put there, and I'm happy I just remembered, is to be careful how you structure yourself business-wise. Those are things you want to be having conversations about, because a lot of times people just buy properties and they expose themselves, where if someone were to sue you, guess what could happen? They can come for you, they can come for everything you own. But it's important that you consider having LLCs to protect some of these, but there's a lot more that goes into it, and that's why it's good to have a conversation with a professional. So if you're thinking about going to real estate investing, make sure that you book some time for us to talk. If you want to get more details before you even do that, check out my course. And as always, it's always an honor to be here with you guys. I can't wait to schedule more sessions, so those who want to learn, those that want to acquire more of this information can do so. Thank you all. Have an amazing week ahead. Please send questions if you have any, if there's anything you need any clarity on. I'm always happy to provide that kind of clarity and teach as well. Okay, more lives coming. Stay tuned. Please share the information with someone that could benefit from it. All right, peace out.